Mark Collinsworth of Vere Global with us again this evening on Friday evening, the wrap up of another wild week on Wall Street. Mark, first of all, before we get into buy the rumor, sell the news, explaining what that means, as you can see on the bottom of the screen here, before we explain that, generally, how did it wrap up today after a volatile week? Is the rally over? Are we approaching a bottom? What's to come?
Well, normally, as we discussed, how markets bottom, you usually have that sharp sell-off, which we've had over the last, several weeks. And then the market, based on history, should have a fairly large rally up. That's often referred to as the relief rally or the suckers rally. It builds up a false sense of hope that the stock market's actually formed a bottom. And then here sometime in the near future, the market's going to roll over and start to slowly go down and build up momentum. And it should either retest the low that it set on Monday or break through that low to set a new low, which is usually the low.
Is the wolf at the door ready to blow our house down financially?
I don't think so. Not at this point. I don't think so. There's a lot of things that have to go wrong for you to have like another Great Depression. But then again, if this was 1929, I could say the same thing. A whole lot of things would have to go wrong to cause a depression, and they actually did throughout the 1930s.
I was actually referring to your dog in the background.
Oh, okay. You need to go shut the dog up?
No, that's all right. That's okay. It adds to the ambiance of this.
Okay.
All right, now, buy the rumor, sell the news. You say that explains what's going on with the market now as it wrapped up another week. What do you mean by that?
Well, usually on Wall Street, Wall Street's always trying to anticipate things that are going to happen. So as the rumors came out this week, there was going to be a huge stimulus bill, the president signing the stimulus, the checks going out. So investors started buying up stocks on the hopes that that would actually happen. And then, of course, that's the rumor. It hasn't happened yet. So they buy up the rumor on the anticipation. And then once it becomes reality and they sign the bill, they go ahead and take out whatever profits they've made from the upswing.
So this is kind of following a classical pattern.
Correct. Yes, this is very common.
But yet, the elements are different here. Coronavirus is really something new, a new factor in affecting the market. So does that traditional pattern necessarily hold up now?
That's a big question I keep debating. Historically, there's little indicators in the economy that, a bear market's going to occur. But this time we got the bear market, and now we're actually seeing the indicators actually start to form of a recession. So it's totally different because we have no reference point in history to actually say what happens to the economy when a pandemic hits it.
Now, I notice a lot of the CEOs, including Mr. Diamond of JP Morgan, they're buying up a lot of their own stock. Now, is this the same kind of buybacks that we saw before that they got with the tax cut that Trump gave them, or is this something different?
No, this is actually legal insider trading. So what happens if you are the CEO or CFO or a high-ranking member in a corporation, if you buy stock in your company, you have to report that. And that's what you're seeing right now. And it basically tells you that you're seeing like actually record amounts of legal insider trading. And that tells you that these people actually see a lot of value in their company and they actually see light at the end of the tunnel.
So that means it's a good prospect for what's coming in the stock market?
It does. Historically, if you look back, let's say 2008, you saw the same record amount of insider buying in November of 2008, but the market actually didn't bottom out until March of 2009. So they're always a little bit early, but they're always pretty accurate.
All right, so as you predicted, we had a few days of rallies, and would you say that it's a triple type of adjustment that goes on before you really start seeing the beginning of what could be a bottom?
Correct. It's a bottoming process. So like I said, the market sells off, bounces, and then it has another sell-off. That's pretty much to shake out the weak hands. A lot of people on these corrective bounces think it's a bottom. They jump in and they get a lesson taught to them that maybe they shouldn't be in stocks. They should leave it to the professionals.
Now, some people are surprised that since Trump signed the bill today, that it didn't give the stock market a big boost. In fact, the stock market went down. How come?
That was because the rally that you were expecting today actually happened yesterday. So they were anticipating him signing it today, bought it yesterday, and then selling today. Not to mention today's also a Friday, And based on previous Fridays going into the weekends and then waking up and seeing the stock market down 2,000 points on Monday, a lot of people probably didn't want to press their luck come Monday morning.
How much of a stimulus will $2 trillion be to the economy, that $2 trillion stimulus bill that the president signed today?
That's going to be a lot. If you go back and look at, when Ronald Reagan did their tax cuts and the Fed cut interest rates back in the early 80s, and then you look at the same stimulus programs with TARP and the tax cuts in 2008, this stimulus package actually is larger than both of those combined.
But it's going to be a delay action, though, isn't it? A delayed effect?
Correct. It takes time. Just like you saw in 2008, all these stimulus plans got put in place in November of '08, but the market didn't actually bottom out till March of '09. And even then, it took until roughly May until you actually saw the economic numbers starting to pick up from the stimulus that was being injected in November.
All right, you're a money manager. You had a managed money account. You're the guy who manages it and adjusts it according to stock market conditions. I know you've been getting tons of calls from your clients this past week and the week before. So at the end of this week now, on this Friday, what do you tell them to do come Monday?
I tell them we've had a very nice bounce, and now let's start raising some more cash, because I want to be cash heavy when we actually go and set that next bottom, because if you let that next bottom is when you really want to start buying into it, and I want to try to pick up the stocks there.
So you've been going to cash on a portion of stocks,
Mm-hmm.
and that way it'll be in reserve for when when the stocks start rising again. Is that the plan?
Correct. And a lot of things I've actually been selling is just things you just don't want to own in this kind of environment. With the Fed cutting interest rates, you want to kind of stay away from banks right now, because banks actually lose money when interest rates get cut. So we've been getting rid of some of our banks. We've been getting rid of some, real estate companies. You don't want to own real estate in this kind of environment. The kind of things you actually want to look at in this environment are technologies. We're going into, we have a new economy, so you want to look at technologies, especially the ones that do, working from home. You want to look at software companies, and maybe even do a little bit of picking on travel companies, maybe like a Disney or something that's been beaten up. Start nibbling on those a little bit over the next few weeks.
Now you're predicting the market is going to come roaring back with all this infusion of money with the stimulus bill. How soon would that happen?
Well, the last time we had a stimulus package anywhere as near this size was in 2008, and like I said, it took the market roughly 4 more months after that. So if I had to guess, you'll probably see the market will probably actually start picking up and doing much better probably in late May, early June, on the anticipation of a stronger economy and people returning back to work from the coronavirus.
But if the shutdown lasts longer because the virus has not been contained, maybe several months longer than that, then how long does it take to roar back? Or, people are asking, will it roar back at all if you have a prolonged shutdown? Will the damage be irrevocable then?
If we can get people with all this money to start going out and actually start shopping again, I think we'll have a very quick recovery, and it'll be a deep recession, but a very short recession. But you're correct. If the coronavirus doesn't go away, it could turn a very short recession, could turn into a very long recession.
And will there be an eventual recovery if the recession is long?
There will be, because at some point they'll actually come up with a cure or a vaccine for the coronavirus, and that'll fix the problem there. But even with the way with the FDA regulates biotech testing, it could be at least a year out before you even get an approved medication, and then even after that, it could take another 6 months to actually get enough of production to actually make a dent in the coronavirus.
Well, with all that time passing, if people are shut in for, let's say, 3-4 months, maybe more, you still are confident that the damage will not be, it would still be correctable, and the market would still come back heavy, strong.
It will, but we're also, at the same time, we're also running out of time. The economy can be shut down for a short time period, but not much longer. I saw an estimate today that most of your restaurants in the United States can actually go for about 9 weeks without having, opening the doors up for customers coming in. But once you start getting beyond that 9 weeks, there's really no hope for those smaller restaurants to have any chance of actually coming back.
Well, Mark, that's what I'm asking. If the shutdown is prolonged, then will the market come roaring back? Will the economy start functioning again, or will it be permanently depressed?
Well, I don't think it will ever be permanently depressed. I mean, we came through the Great Depression, World Wars, and things of that nature. It might not come roaring back in 6 months, but somewhere, in the Great Depression, it actually took 4 years for the stock market to come roaring back.
Yeah. All right, some historical precedent there. Let's hope that holds true this time around. Mark Collinsworth of Vere Global, thanks once again for giving us this Wall Street wrap up.
Well, thank you.